Traders talk a lot about entries. They talk about edge, talk about profit, but they rarely talk about this. What happens when your strategy fails? Because if you're not ready for the storm, your system isn't finished. Today, we're breaking down the safety net most traders ignore: ability to offset your risk of drawdown. For those of you that are new here, my name is Mark Anderson, construction worker turned 0DT hedge fund manager. I've sold over $50 million in 0DT premium across over 1,000 consecutive trading days. For today's video, I'm doing a deep dive into the fourth pillar of my Core 4 framework, and it's the one that separates a winning strategy from one that quietly bleeds out. What is drawdown risk and why it's not just about your losing trades? Let's start with a basic definition. Drawdown is the loss from a portfolio's peak to the lowest point before it recovers. But here's the part most traders miss. It's not just that you take losses. It's how those losses happen that determine whether your strategy survives. You could have a higher win rate, a strategy that looks great on paper, but if your losses cluster, spike unexpectedly, or spiral without a cap, you're toast. That's why I say some strategies don't fail fast, they just bleed out. Traders often obsess over win rate or premium collected, but they ignore the real question. What's your mechanism for cutting losses or softening the blow when things go wrong? Because they will go wrong. It's like driving a fast car with no brakes. You're fine until you're not. A good strategy isn't just built to win. It's built to take the hits and keep on going. The three types of offset mechanisms. So now that you understand why drawdowns aren't just about losses, let's look at how we actually reduce them by design. 1. Fixed stops with predictable risk management. Most traders assume dynamic stop losses are smarter. They think that dynamic stop losses help them exit only during high volatility or when market structure breaks. But while dynamic stops might feel smart, they can actually introduce more risk than they remove. When you rely mostly on context-aware exits, your losses can balloon unexpectedly, depending on speed, slippage, or delayed reactions. Instead, I prefer fixed risk stop placement, even if it feels a bit blunt. Here's the logic. If I sell an option for $2, I set my stop at 3x or 4x the credit received, so my max loss is $6 or $8. This means every trade has a known consistent risk profile, not just guessing and no surprises. I've said it before and I'll say it again. Building wealth is managing risk, and dynamic stop losses introduce too much risk and too many unknowns. Fixed stop losses have more predictable losses and are easier to compound against. Even if we take a hit, the system holds. It's like driving a car with a seatbelt that locks at a known force instead of trying to detect the right moment to protect you. I'd rather be clipped in and know what happens than hope it reacts in time. 2. Diversification of trades or timing. Not just having multiple trades, but offsetting risk curves. Staggering entry times using opposing strategy pairs, like credit trades and debit trades. Pairing a morning trend strategy with an afternoon mean reverting strategy can smooth the P&L even if one fails. 3. Hedging, tactical and structural. Protective positions like long straddles, far out of the money puts, provide direct inverse exposure to the risk that you are taking. Structural hedges are always present. Tactical hedges placed when signals occur. Think of it like this: airbags versus defensive driving. You want both, but theory is one thing. Let me show you how this plays out in real life. Let's take a real event, April 9th. That morning, we had short calls on in our 0DT portfolio. At the same time, we were holding long calls with a 10 days to expiration. Then boom, Trump makes an unexpected announcement. The market spikes 8%. The short calls took a big hit. Massive slippage, our trays filled at 2 to 3 times more than our expected stop loss. But the long calls, they more than covered that loss and then some. Our first line of defense was our stop loss. It failed. But our hedge stepped in during that extreme of a move, and the portfolio still came out positive and ahead, and by a big sum. That's the power of layered defense. When one risk control breaks, another catches that fall. That hedge didn't happen by accident. It was part of the structure, audited, tested, and built into our zero DT trading system. Which brings me to the real question. How do you audit your own strategy? Great strategies aren't just built, they're audited. Here's how I think about it. 1. Your system should report out to you. If you're manually entering in data into a spreadsheet, you're behind. A real strategy is programmable, repeatable, and observable. The system should run independently and report out what it's doing daily to you automatically so you can always keep track of it. I check mine every afternoon after the market closes, but the real audit happens weekly. That's when I compare what my forward test is from my actual live trading to my back tested assumptions and results. That difference between the live trading and the back tested performance is really when you know you've got a system that's working correctly. You want a system that makes errors visible before those errors become expensive. 2. Build in a statistical check, p-values in my tracking. One of the best tools I use to support problems early is a p-value analysis. A p-value tells you how likely your results are to be random. So a p-value of 0.001 means that you're 99.9% certain those results are non-random. A p-value of 0.9 means that you are 90% confident that the results are random. It's basically a coin flip. Here's how I like to use it. For my core trades, selling options, I aim for a p-value that's lower than 0.001 or better. For hedges, I'm fine with a p-value near 0.9 because they're meant to catch on tail events, not to be consistent winners. They pay when that randomness comes in. If your strategy's p-value drastically shifts from 0.01 to 0.1, you may not have an edge. That's a real red flag, and the data is telling you loud and clear, look at that thing. 3, know your size and your worst case scenario. Edge doesn't matter if your sizing wipes you out. If you take a 25% drawdown, it takes a 33% gain just to get back to even. This means you just lost 8% of your edge from sizing alone. I size so that even if everything goes wrong, I'll only lose 3% on my account for that day. Example, I may sell 1% of my account per day. If all fails, worst case is a 3% loss. If that happens 3 days in a row, that's still within my margin of safety. My rule, plan for when things go wrong and that it'll still be okay. Your worst case P&L should be half of what you're actually comfortable with. That's responsible risk, and I promise you, whatever you think your risk is, it's less than that. 4, offset by design. Don't rely on hope. Offsetting risk isn't optional. I sell a large amount of premium, but I'm also one of the biggest buyers of options as well, and that's by design. Even if you're the one selling insurance, you still need to buy it. Big insurers do it, hedge funds do it, I do it. Here's my benchmark. For every contract sold, I always buy a long contract. For every $8 to $10 in premium I sell, I spend $1 to $2 on protection by buying premium. That dollar insurance lets me take smarter, more responsible risks without the fear of large drawdowns. Bottom line, if you're not auditing your strategy, you will fail silently. Consistency, statistical proof, conservative sizing, offsetting exposure, that's how you build something that survives. Even with a solid audit process, there are still some landmines along the way. Let's run through the biggest ones I see traders fall into so you can avoid them yourself. Common mistakes to avoid. Every good strategy can quietly fail if it's built on bad assumptions. Here are the most common mistakes I see, even among experienced traders. 1. Blindly trusting stop losses. Using stop losses without understanding the why behind them is like guessing your way through a backtest. It's like driving at a high speed in a snowstorm because it worked when the roads were dry. Just because your system made money for 5 years doesn't mean it'll survive a market shock like 2020. Risk protection isn't about arbitrary rules. It's about understanding what risk you're actually defending against. 2. Focusing on returns instead of risk longevity. Most traders are obsessed with how much they can make. But what matters most is how much you can make over time by protecting against risk well. If you're sizing it off, you can lose your edge even with a great system. Think of it like smoking in your 20s. You might be able to skirt by in the short term, but it will catch up with you over time. 3. Misunderstanding diversification. A lot of traders think that they're diversified just because they're running different trades. But if all your trades fire off at the same time with similar logic or setup, they're probably correlated when it matters most. When things go bad, correlations tend to all go to 1. You want true offsets, not just a bunch of lookalikes. 4. Believing high win rate is equal to a low drawdown. This one's dangerous. A 98% win rate looks great until it becomes a 96% win rate and your drawdown doubles. High win rates often hide fragility. A single extra stop loss adds massive weight to your data. Lower win rates with tighter risk controls are often more stable over time. 5. Oversizing for short-term gains. Sizing is your survival. Full stop. Traders get greedy chasing bigger gains without realizing how much edge they're burning through. A 25% drawdown requires a 33% gain to recover from, meaning your edge just took a permanent hit. Longevity beats bravado always. In trading, it's not just about what you gain. It's about what you can lose and still keep going. Avoid these traps and you give your strategy the time it actually needs to work and make money for you. If nothing else, remember this. Drawdown management isn't reactive. It's a core design choice, and it's what separates portfolios that compound from the ones that blow up. Offset of drawdown risk is what allows a portfolio to keep compounding instead of resetting constantly. It's not about predicting pain. It's about building for resilience. Want to see how I structure this in my portfolio? Check out the next video linked below about the Core 4 recap and a strategy deep dive. Drop a comment below if you're experiencing a drawdown you could have managed better, or if you want me to review one of your strategies and the weak spots I see in it for a future video. And if you found this helpful, like, subscribe, and share it with another trader who needs to build a more resilient trading system.